So one thing I observed that because this may be for my act that the actual means and this is the expected. Please go last slide. This is expectation, but actual may have changed. So A by E ratio is not 100%, but it's me only. So today's topic is implications of IFRS 17 standard. So this is a very interesting and relevant topic in today's time, more so for India because of recent developments and few initiatives and very important initiatives have been taken by the insurance regulators. Uh, and as we all are aware that in the month of April, the Ministry of Corporate Affairs have notified the IFRS 17 standard in the form of INDAS 117. This is a convergence of IFRS 17. And apart from that, the IRDAI has constituted a dedicated mission mode team for implementation of IFRS 17, and a lot of steps have been taken by the IRDA mandating the insurance companies to form internal committees for implementation and also for submission of gap assessment, carrying out gap assessment and submission to the regulators, and simultaneously phase-wise submission of IFRS numbers in a specified or prescribed format called proforma IFRS statement format, and that is also phase-wise. We are not pressurizing all the insurance companies to come up, but insurance companies can voluntarily come up. So this is the brief background, and along with that, we all know that the IFRS 17 is a very high-level principle-based approach, unlike the RBS, that is risk-based solvency framework in any other countries if we see. And then IFRS 17 have many issues and concerns. Of course, issues and concerns will be there for implementation of any new framework in any country. However, those concerns and issues are manageable definitely, and solutions are there, problems are there, solutions are there. And some of that are related to the systems, processes, expertise, resources, and more so for understanding the contract, and there are possibilities of varying interpretation for every technical aspects. For example, I will give you one example that the discount rate in IFRS 17 for discounting the liabilities, and if we see the risk-based solvency in most of the countries, particularly in Solvency 2, that is based on discounting rate is based on the risk-free interest rate. Whereas in IFRS 17, the determination of discount rate is quite different. It depends on the top-down, bottom-up approach, assets, liabilities, all these things are taken into considerations. Like the disclosure requirements also. Now, profitability of each and every insurance contract, maybe in bundle form, should be disclosed properly. And there are also other aspects, which I think challenges and other concerns, issues will be explained by Mr. Francis. So I will invite Mr. Francis to please take up that. Yes.
Thanks. Yeah, can you go back to the first page? Okay. Thank you, everyone. It's my honor to have some time to present this topic here. Today I have four main importance agenda here. So if you can see that I probably will go through a bit of the standard itself, and then I will go through a bit of the challenges of the implementations, as well as how it will impact your financial planning and analysis. Last but not the least, I probably will go through a bit, quickly go through a bit of the new KPI under the new IFRS 17 standards. Okay, so basically the standard has been first issued in 2017, where initially it's supposed to be go live in 2020, but it had been delayed for a few years. The first go live country will be the company in Europe, where it's in 2022. So the aim of the standard basically is to have a standardized global accounting standard for insurance contract, so that to provide investor a clearer pictures of the profitability of the insurance contracts, as well as have a better comparisons between the companies, so that the investor can make a more insightful decision about what company they are investing and what product they are supposed to price. So, sorry, can I go back to the first? So basically, for the standard, there are three pillars here. The first one will be the compatibility. The second one is transparencies. And of course, for the informations. While information we are talking about here is the disclosure reports. So as you know that under the new standard, the disclosure report has been a lot different from what you are doing at the moment for IFRS 4. And the standard actually also provide instructions on the valuation methodologies depending on how you classify each of your products. Whether is it under a GMM where you do not have a direct participating features, or it's supposed to be a VFA where you basically have a majority of the direct investment impact into the insurance contracts. Or otherwise, if your product is more simple, you probably can take a shortcut approach, which is we call the PAA approach. Okay, so these are basically the three valuation approach that the standard are requiring you to do so. Okay, so given the standard requirements, so you started to think about you need to kind of completely review your actual models, your accounting process as well. So whether there's anything new that you need to model in your actual software, is there definitely you will have a lot of new chart of account that to be implemented in your journal ledgers. So these are the things that will be impacting in your valuation reports, in your financial reporting as well. So beside that, you have to think about the reporting timeline as well. So given the standard requirements, now you have a more complicated process. You have more granular data to produce. So the time taken to produce the result will be maybe a lot longer, maybe a few days or few weeks longer than what you're doing now for IFRS 17. And furthermore, you probably need more time and resources in terms of doing a more high quality analysis for the business, so that you can explain to your management what exactly your business is, where the profitability is coming from, and how is it impacting your future developments. Lastly, of course, because the standard, even though it's go live for about 3 years in Europe, some Asia country also already go live like Singapore, Hong Kong, but the standard itself is still quite new. Okay, so the implementation of what the standard required might still vary. So when people started to look at the result or they started to do the implementation, they probably will face a bit of the variances that what is expected from the standard itself, or actually the comparison between countries and between the company probably will have a bit of differences also. So beside those what I have just mentioned, you probably would think about more practical challenges that you have when you are implementing the system, when you are submitting the reports, or even when you are explaining the result to your management or even to your regulators. So some of the more practical challenges that you can think of is the coordination between the stakeholders. With the standard itself, the actuaries now is not working alone. They need to know what the accounting is thinking, and the accountant need to know what the actuary is thinking and where the figures is coming from. You need to have a clear audit trails from the input itself, go through the actuarial system, went through your accounting system, and then produce the result. How are you going to analyze the result, and how are you going to explain the result to your management, to your regulators? So to overcome this, you basically will need to have, during the implementation, basically the first thing, you probably need to have a good project management. You have to have a good project plannings. You need to have an open communication between the stakeholders to understand what each of the stakeholders need. What the actuarial needs might not be what the accountants need. But eventually, you guys need to work together and come up with the disclosure reports that can explain the situation of the companies. They can explain the profitability of the contracts. They can explain all the figures to your management, which can help your management to do further business planning or enhancement in the business so that you can be going forward. Besides that, you also need to have a flexibility to adopt changes. Like I mentioned, the standard is new. So probably during the implementations, you probably will face some changes. You need to make decision quick, given the deadline, given the short times of the implementation times given. You probably need to make quick decision and make a good decision and then adopt the changes accordingly. So after all, I've been involved in implementation of IFRS 17 since 2019. So now it's around 5-6 years. I've been helping more than 40 clients in APAC in terms of the implementations. So one thing I noticed is the standard itself is complicated. So don't make the standard even more complicated. Follow the standard, do the simple compliance. When you get used to the standard, when you understand more, then you can start to enhance even further to meet your internal requirements, to meet your business planning, to meet your analysis, right? So as I mentioned here, so it's easy to make a simple task complicated, right? But it's difficult to make a complex task easy, right? So that's basically what I mean here for this slide. Okay, so after your implementation, what is next? You probably think of, okay, after I have the implementations, I submit the disclosure report, I submit the figures. So what is next after that? So given the technologies, right, you probably want to think about automations, right? Even after the automation, you will think about how are you going to do your financial business and planning? How are you going to analyze the result so that to help your management to make a good decision in terms of how they develop the business? Okay. Yeah, okay. So when I talk about the next step, one of the next step probably will think about the financial planning and analysis, right? The financial planning and analysis itself is already complicated. It involves a lot of data, it involves a lot of assumptions, it involves actuarial modeling, it involves your accounting process, it even involves management decision in terms of how are you going to build up the financial business plan. So given so, under the IFRS 17, it even makes the whole process even more complicated. You just think about the granulations of the data, right? You need to have a more granular data. You need to split the one product into ownerless, non-ownerless, and others, right? For those granularity, it basically will give you even more complexity in terms of how the process and how you're supposed to do your financial business planning as well as analysis. So the key impact of the standard for the financial planning and analysis, right? Like I mentioned just now, the most key impact probably will be your data granularities, right? With the requirements, now you need to have a more granular data in terms of all the projections. How are you going to measure each of the insurance contracts? Besides that, all of the financial planning analysis, you're not just talking about the baseline, right? You probably have 8 scenarios, some people have 16 scenarios, so that you can have when the market is good, what will happen to your business plan? When the market is not good, what will happen, right? So it probably will involve a lot of processes from the beginning to the end. So it's just like you imagine that you are doing the whole IFRS 17 process for 10 times, for 20 times, depending on your requirements, right? You probably want to shop about your discounting rate, you want to shop of your new business, you want to shop your assumptions, right? All those will complete a lot. You will produce or will contribute a lot of complexities as well as many efforts to get it done. Okay. So some of the things you might want to consider, right? Given the complexity of the process, the granularity of the data, you probably want to take a balance between accuracies and the times required to produce the whole report. Maybe some of them you can use approximations. It probably can shorten some of the time because it's anywhere for business planning, right? It's not the actual reporting. You probably also need to think about the new business and new product that you do not have enough time to model in your actual models, but yet you need to include in your business plan. How are you going to do it? And the management actions, right? All business plan will involve a lot of management actions or management decisions, right? It's not just based on the model itself. So it also need to involve some of the management expenses that you need to include when you are doing your financial business, financial planning and analysis. And also some future methodology changes, right? If you are doing a long enough business plan, for example, 3-5 years, maybe you want to consider after 3 years, some of the methodology might change. So those are something that you also need to consider when you are doing the financial planning and analysis also. Modeling change, as mentioned, right? Some of the modeling changes you might want to consider also, as well as some of the adjustment. And the output now, because of the IFRS 17, just like what you are providing to the regulator in terms of the disclosure report, is totally different now. Right? So now you won't see the actual premium coming in. The profit that you're looking at is actually your expected release of your claims, of your expenses, plus the expected release of part of your CSM, right? Depending on your coverage unit, depending on your business features. So all these probably you want to consider. So with all this, it definitely will complicate the whole process for the financial planning and analysis. So the quick way is you are using a spreadsheet to do it, right? You probably will use what you're using now, build up more tape, build up more spreadsheet. Some of them might write a macro to do so. You can do so. But you also need to think about the complications. What if something went wrong in between? With all this spreadsheet, whether is it auditable? When the management asking you a question, are you able to find out what are the changes, what are the impact, how you generate the results? So the other way is you probably leverage whatever you are using, whatever solution you are using for IFRS 17, try to reproduce the figures by using different data so that you can include in your financial planning and analysis. So here I list out a bit of the key features that you should look at when you are thinking about getting a solution for financial planning and analysis. So basically you can say the first point is basically you will need to use the same model as what you do for your baseline. And if you have business in other country, or if you are multinational company, probably you want to use the same software or same solution as what they use. So that when they do a consolidations, it probably is much easier. And when they explain things, it's much easier. And when you get the support from others, it will be much easier rather than you're using alone. So the result gathered from others' models, like I mentioned, the financial planning and analysis involve a lot of data and models. So the solutions for the financial planning analysis, you probably need to have to be allowed you to input those assumptions, those cash flow, those data, so that you can complete the whole business planning. Rather than you have a bit of here in the spreadsheet, a bit of there in other spreadsheet, right? Then you need to combine everything together. And one set of calculations for all scenarios and time periods, right? So like I mentioned, you can think of you are running a baseline for 20 times, right? Or you can probably have a solution to set up all the assumptions, set up all the data, and then just run one times. Then you can have all the 10, 20 scenarios that you're looking for the financial planning and analysis. Okay, and of course, like I mentioned, with the solutions, you probably want to think about whether the solution can provide you the tracing of all the calculations, right? Otherwise, you probably will be the same as what you're using the spreadsheet. So you probably want to think about you have a clearer tracing of the figures. You better have a better audit trial from your input, your methodologies, your calculations, and your output as well. Okay, so to overcome all this, so we basically have built up a solutions So we call it risk integrities for financial forecasting. So these are some of the screenshots from the solutions. Just share a bit of with you. So your solution probably will need to have all the key metrics that you're looking for the financial planning and analysis. And it have to have all the audits when the projection is being done, by who, and how it's being done. You probably want to also have something to show all the scenarios. What are the baseline? What are the positive outlook? What are the negative outlook? So you can make all the comparison in one page, right? Rather than open all the spreadsheet and copy everything together. So beside the key metrics, the summary, you probably also want to have a comparison between your P&L, right? Because after all, your business plan is all talking about your bottom lines, right? What are the profit you are expecting based on the baseline, based on the positive outlook, based on the negative outlook? So finally, the auditability and the tracing, right? From the input that you input to the solutions until how you get the figures, all the way have to be traceable so that when there's questions from the management asking you about the figures, you are able or you are capable of getting all the information to get it all explained to the management. Okay, so last but not the least is I probably want to share a bit of the so-called the new KPI under the new standards, right? So so for this slide, we are just basically trying to reconcile the combined ratios before and after IFRS 17, right? So what we realized that most of the company, they will have a better combined ratios. The majority is coming from the discounting and the changes, as well as the classification of the expenses, right? With the new standard, now you have the so-called the attributable expenses and non-attributable expenses. So what expenses to be included, what expenses to be excluded, so that will definitely impact your combined ratios. Okay. For this slide, so basically what we are trying to show is the new business value will still be your key KPI. It's no doubt, right? You probably will still look at new business. But we realize that different companies might have different definition or different interpretations of the new business value. Some of the company, they probably just look at the CSM, what we call the contractual service margins. Some of the company not just look at the CSM, they probably look at others items. Okay. So overall, I think what we are trying to say here is despite the submission of the full standard financial statements, right, the KPI are still in discussions, right, even until now, right? They don't have a consensus yet. There's no consensus in the market that which are the KPI is supposed to be. And definitely there are some would be shared by the companies because, for example, the new business value, right? Some of them might be specifically for different companies. And the different definition of the KPIs persists as mentioned because they probably have different definition in terms of the KPI that they're looking for. But eventually, right, given time, they probably will converge into similar, even though it's not 100% same that you can compare between the companies. So after all, even though the new standard is coming in, right, you have a new valuation approach, you have a new disclosure report, but it doesn't change the underlying economics, right? The business is still the business. So what is changing here is you are giving a more transparent analysis to everyone, to the stakeholders, to understand where the profitability comes from, what is your company value, right? So that they can understand, based on this one, they can make decisions, what kind of product to be priced, what product are more profitable that they want to continue to sell, and what kind of product that is actually making losses, it doesn't make sense, they probably want to stop it, right? So it's just giving you more transparent information. It doesn't change the underlying economics. Last one is because of the CSM, the so-called the contractual service margins, right? Now you don't just recognize whatever income that you receive under the IFRS 4. For IFRS 17, you have to project or you have to recognize partial of the cash flow that you receive every year. Even those that eventually at the end of the contracts, right, whatever is making from the insurance contract, whatever is making in the business is still the same, right? As I mentioned, it doesn't change the underlying. Eventually, it will still be the same. What is different is the discounting, depending on how long you recognize your profit. Okay? Yep, I think that's all for me. I think it's just all right. Any questions?
IFRS 17, various elements of IFRS. Before going to the audience, I have a couple of questions.
Yep.
The first question is that, according to you, what is the need and level and extent of alignment with the solvency framework of a country in generic? And another is that, is there any need of standardization of various elements, provisions, where there are subjectivities and there are scope of different type of interpretation, and of course different interpretation may lead to different outputs, different numbers. So from that perspective, if you throw some light on these two issues.
Yep. Okay. I think of course the still as I always think that the new standard coming out is basically they consider combining many standards. Right? Like for example, the lock-in rate, they probably come from the US GAAP. The contractual service margin is coming from Australia GAAP that they are call it about the service margins. Right? Definitely, they leverage a bit of the solvency too. Okay, but at this stage, I don't think we can totally leverage on that, and we can't really combine it for the moment. For the second part, I think it's important to standardize the interpretation of the standard. Because as mentioned, the standard itself coming out is really want to standardize even globally, not just between the companies. They want to standardize how you interpret the reportings. The figures that you report, what is this represent? And whether is it comparable to other countries, other companies, right? So that's why I think it should be standardized, but I understand that in some difficult situation, you probably will still need to allow a bit of room for them to make some changes or based on the company portfolio.
Yeah. Thank you very much. Now we'll go to the audience. If you have any questions, any suggestions, please come out. Anybody, please.
So the country which you mentioned where IFRS got already implemented, and subsequently you said business, even in business planning also that's impacting the way we do business plans and KPIs. So just wanted to know, is there any subsequent impact in pricing also, like when you price product, the traditional approach we follow for pricing products, so whether post implementation of IFRS, whether that methodology also going to change the way you price products?
Yes, I think it will change, but at the moment I didn't see much, especially in Asia. I think in Asia-wise, in general, we used to price the product based on the market situation, right? You can't price something that is profitable but cannot sell. So maybe most of the time, you will still need to stick with how the market react to the product, right? But I think something can change is within the product itself, we always used to subsidize each other's, maybe subsidize the age, subsidize some of the, some country might even subsidize the sex, right? Because they are unisex pricing. So with that changes, I think definitely we can take the first step to make some simple changes on the pricing first. right? The other example I heard of would be the reinsurance, right? Given the reinsurance complexity, when they do a treaty, they cover a lot of different products. So they used to price like this, but now with the granularity of the data, they probably want to change how they're supposed to price it so that they can have a better linkage between the underlying contract as well as the insurance contract.
Thank you.
Anybody, please? So we assume that there is no further question. So we can go to the next.
Thank you. Thank you so much.